Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know First Senator Warren assails Fed nominee Warsh's record, escalating the political battle for control of the US central bank. Today, we'll take a closer look at this high-stakes power struggle and its implications for the Federal Reserve's independence and future monetary policy. Second, OECD scraps global growth upgrade on Hormuz, energy shock, now forecasting a stagflationary 1.2 percentage point jump in G20 inflation. We'll explore how this stagflationary shock creates a policy nightmare for the Fed and ECB, forcing a choice between fighting inflation or avoiding recession. Third, Russia's 50% oil revenue plunge triggers a budget crisis, forcing Putin to demand personal donations from oligarchs to fund the war. We'll analyse why this desperate fiscal measure signals Russia's war funding capacity is nearing its limit and what it implies for the ruble stability. The most unexpected news out of Washington today has to be a letter sent to the man nominated to lead the Federal Reserve, telling him to his face, "It appears you have learned nothing from your failures." That's a direct quote from an 8-page letter sent by Senator Elizabeth Warren to Fed Chair nominee Kevin Warsh, a letter she calls an indictment of his record. Warren accuses Warsh of being a rubber stamp for President Trump's Wall Street First agenda, stating his performance during the 2008 financial crisis should disqualify you from a promotion. This fight over the Fed chair isn't just political theatre, it's about the fundamental direction of the US economy. A confirmation of Kevin Warsh could signal a major structural shift in how the Fed operates. Now, get this. Warsh is known for what experts call the Warsh Doctrine. This is a hawkish approach, meaning he would prioritise fighting inflation above all else, even if it means risking higher unemployment. That's significant because it would force a major repricing of long-term investments and substantially increase the risk of a recession caused by the Fed's own policies. And remember, a while back we dug into why importing a pure Volcker-style playbook into today's economy is risky. Much of the remaining inflation is in sticky services like housing and healthcare, which don't cool quickly. So a harder anti-inflation stance could bite jobs long before prices bend. The letter is a blistering attack, claiming Warsh ignored excessive risk-taking, worked tirelessly to bail out large financial institutions, and advocated for policies that would have harmed millions of Americans. The rubber stamp for Wall Street accusation isn't just a slogan. It points to a potential great regulatory unwinding. A Fed led by Warsh could systematically weaken the financial regulations put in place after the 2008 crisis, like the Volcker Rule, which stops banks from making risky bets with their own money. While this could boost bank profits in the short term, it could also reintroduce the hidden systemic risks that led to the 2008 meltdown in the first place. Warren even cites an ethics waiver Warsh obtained to deal directly with his former employer, Morgan Stanley, during the multi-billion-dollar bailouts. But that's not the whole picture. The real turning point is that a few days ago, we mentioned the DOJ's criminal probe into Jerome Powell over the Fed's headquarters. Renovations looked less about interest rates and more like a pressure campaign. Powell invoked Paul Volcker's mantra of resistance and pledged not to step aside until the probe is resolved, while a top Republican vowed to block any replacement during the investigation. Warsh's nomination is already in limbo. Another senator is blocking the entire process from moving forward due to a separate, ongoing criminal investigation into the current Federal Reserve Chair, Jerome Powell, which has been criticised for lacking substantial evidence. The US attorney for the District of Columbia is investigating Powell over cost overruns at the Fed's headquarters, a move a federal judge suggested was designed to harass and pressure Powell into resigning, noting the lack of substantial evidence. Continuing our last discussion about the Fed's independence, this isn't just a confirmation hearing, it's a high-stakes power struggle for control of the US economy, with the White House, the Senate, and the Department of Justice all in the ring. The reality is, this intense political pressure is chipping away at the Federal Reserve's most valuable asset, its independence. It's a fascinating situation because when a central bank is seen as being controlled by politicians, it can unanchor long-term inflation expectations. Investors start demanding a political risk premium on US government bonds, making it more expensive for the government to borrow money. It draws parallels to the Nixon-Burns era in the 1970s, where political pressure on the Fed contributed to runaway inflation. The fight over who will lead the Fed is now entangled in accusations of past failures and present-day political warfare. Warren's letter makes the central conflict clear, stating Warsh's track record raises significant concerns about your ability to direct economy, altering policies for American workers and communities. So where does this leave us? First, the market is already getting nervous. The uncertainty is driving up volatility in the bond market, which increases hedging costs for businesses and can be a warning sign of broader financial instability. Second, for our audience in Asia, a hawkish Fed under Warsh would likely trigger a significant strengthening of the US dollar. This would tighten financial conditions around the world, putting a strain on emerging market economies that have borrowed in dollars. This could also put downward pressure on the yuan, potentially forcing a policy response from the People's Bank of China to manage capital outflows and maintain stability. Third, as we said a while back, the real policy pivot won't come from headlines, but from wage dynamics. Watch the employment cost index for a decisive cooling in sticky services inflation. Speaking of inflation and recession risks, the global economic picture just got a lot more complicated. The Organisation for Economic Cooperation and Development, the OECD, just released a critical new report. They had been on the verge of revising global GDP growth upward by 0.3 percentage points, a sign of stronger than expected recovery. That revision has now been entirely erased. A while back, we analysed how choke points like Hormuz were being weaponised and flagged early tremors, Wizz Air's profit warning in US, carriers signalling rapid fare hikes as the canary in the coal mine. The latest development is that the OECD has now translated those micro tremors into a full-blown macro downgrade. The cause? An escalating conflict in the Middle East that threatens a near halt to energy shipments through the crucial Strait of Hormuz. This isn't just a regional conflict. It's a direct shock to the global economic system, and the numbers are starting to get ugly. The Strait of Hormuz is the world's most important oil choke point. A significant portion of the world's crude oil and liquefied natural gas passes through this narrow waterway every single day. Any disruption here immediately sends shockwaves through energy markets, which is exactly what we're seeing. And as the IEA's executive director warned a while back, the longer this goes unresolved, the more severe the economic damage becomes. With energy prices soaring, the OECD is now projecting G20 inflation to be 1.2 percentage points higher in 2026, hitting 4.0%. Importantly, this isn't just inflation, it's a stagflationary shock. Now, stagflation is a central banker's worst nightmare. It's a toxic mix of stagnant economic growth and high inflation. This is a supply-side problem, meaning central banks can't easily fix it by just raising or lowering interest rates. And as we've discussed before, household rebudgeting under energy stress can create deflationary pockets. Think air travel and hospitality, while airfare, a very visible CPI line item, swings around and muddies the signal just when policymakers most need clarity. The fallout is hitting the world's largest economy directly. The forecast for US headline inflation in 2026 has been jacked up to 4.2%, a full 1.2 percentage points higher than previous projections. This is where the situation takes a more complex turn. At the same time, this inflationary energy shock is hitting. An unexpected disinflationary force is also at play in the US. A recent Supreme Court ruling determined that President Donald Trump's use of the International Emergency Economic Powers Act, or IEPA, to impose tariffs was not authorized. This has led to the removal of those tariffs on imports from countries like China. It creates a very mixed and volatile environment for the US economy, as lower import costs could partially offset the new price pressures from energy. Continuing our last discussion, expect those deflationary pockets in discretionary categories like air travel and hospitality, even as headline inflation is pushed up by energy. So keep an eye on the transportation services components within core CPI to see how this tug of war plays out. While strong AI-related investment provides some support, it's being offset by a slowdown in real income growth. Believe it or not, this AI investment is acting as a powerful counter-cyclical force. Actually, this isn't just typical business spending. The massive capital expenditure on AI for things like data centers, servers, and software is becoming a powerful force. Research suggests this investment boom is largely insensitive to commodity prices or interest rates. The reason is that companies see AI as a competitive necessity for survival and future growth. This could mean the US business cycle is starting to decouple from traditional economic shocks, making the economy more resilient than in the past. Across the Atlantic, however, the story is much more dramatic. The euro area is taking a direct hit from the energy price surge. The OECD has slashed its 2026 growth forecast for the region down to just 0.8%. That's a massive downgrade from the previous forecast of 1.2%. This is also where household rebudgeting typically bites first in Europe's travel-heavy seasons, consistent with those early airline warnings, so watch carrier guidance and capacity decisions for confirmation. The reason for this divergence is critical to understand. The United States is far more energy independent. In 2024, imports made up only about 17% of its total energy supply, the lowest in nearly 4 decades. The Eurozone, on the other hand, is highly dependent on imports, with a dependency rate of 63%. This high reliance on external energy makes Europe extremely vulnerable to price spikes and supply disruptions from a crisis like the one in the Middle East, explaining the much harsher economic forecast. Now, while the US and Europe are grappling with this, there's another major economy whose story is quite different. The OECD's forecast for China's growth remains unchanged. This suggests China is surprisingly insulated from the Middle East energy shock. There are a few reasons for this. Strategic energy deals with suppliers like Russia have likely secured a more stable and predictable energy supply. At the same time, China's economy is strongly focused on domestic demand, providing a buffer against external volatility. Recent data, like the manufacturing PMI for February 2026, which came in above expectations, indicates a modest expansion in factory activity, further supporting this picture of relative stability. We previously noted that for a major energy importer like China, this instability forces a strategic pivot, locking in supply from Russia and accelerating domestic renewables, which over time could even harden a split in global energy markets between a dollar price system and a Russia-China axis. So what we're seeing is a geopolitical crisis actively knocking the global economy off its growth path. The OECD's warning is stark, urging central banks to remain vigilant as the world grapples with the dual threat of slowing growth and sharply rising inflation. And vigilant in this context means central banks like the US Federal Reserve and the European Central Bank are facing an almost impossible choice. This is a classic supply-side shock. If they raise interest rates aggressively to fight the new inflation, they risk crushing economic growth and triggering a recession. But if they keep policy loose to support the economy, they risk letting inflation expectations become unanchored, damaging the credibility they fought so hard to rebuild after the last crisis. As we said a while back, the inflation signal can get blurred if sectors like transportation services cool while energy stays hot, making decisions even tougher. Key focal points to watch now: monthly inflation data, especially the airfare and transportation services components, airline capacity and pricing guidance, yet fuel inventories in hubs like Amsterdam, Rotterdam, Antwerp, and whether the demand-side measures flagged in the IEA's emergency planning are actually working. Their decisions in the coming months will have enormous consequences for stocks, bonds, and the global economy. 我们刚谈完中东能源冲击如何让西方央行头疼，现在让我们把目光转向另一场与能源相关的危机。这场危机是俄罗斯自己造成的，正在其国内上演。有报道称，弗拉基米尔·普京已要求俄罗斯的寡头们为国家日益减少的国防预算进行个人捐款，以继续对乌克兰的入侵。这并非简单的募捐请求，这实质上是一种不可预测的强制性税收。专家们称之为寡头看跌期权。这里的关键风险在于，它将私营企业置于极高的风险之中，因为企业无法预测下一次现金需求何时到来。这与中国通过更有条理的政策推动的共同富裕有着根本区别。在俄罗斯，这直接与战争经费挂钩，很可能会扼杀私人投资，并加速资本通过任何可用渠道外流。在俄罗斯，国防开支激增42%。达到惊人的 13.1 万亿卢布之际，这一史无前例的呼吁应运而生。然而，这还不是故事的全貌。在今年的头2个月，俄罗斯的预算赤字就飙升至全年预测数字的 90% 以上。根据俄罗斯财政部自己的数据，赤字达到了 1.7 万亿卢布，其主要驱动力是石油和天然气收入，同比暴跌 50%， 创下5年来的新低。这场巨大的现金危机是由制裁迫使莫斯科以大幅折扣出售其石油所引发的，这正是七国集团价格上限机制的直接后果。这项政策将使用西方海事服务的俄罗斯海运原油价格上限定为每桶60美元，并且已经生效。美国财政部的数据显示， 该政策导致去年俄罗斯的石油税收减少了 45%， 直接削弱了该国为其行动提供资金的能力。克里姆林宫现在正手忙脚乱地试图填补这个财政黑洞。在2023年一次性征收 10% 的税费，带来了3200亿卢布之后，他已经在考虑对大公司征收另一笔暴利税。与此同时，增值税被提高到 22%， 试图在3年内从企业身上再挤出6000亿卢布，压力从四面八方涌来。而且这种压力不仅针对大公司，普通民众也感同身受。实际上，飙升的预算赤字主要通过货币化来为战争融资，这是导致国内通胀持续高企的根源，这直接侵蚀了俄罗斯人民的实际收入和储蓄。我们已经看到这种情况正在发生，年通胀率达到了 6%， 远高于央行 4% 的目标，这迫使俄罗斯央行长期维持鹰派的高利率政策，从而扼杀了非军事领域的经济，形成了一个恶性循环。但最能说明问题的细节来自普京本人，他直接警告商界领袖，告诫他们不要因油价上涨而得意忘形。他说，我们必须保持审慎，如果市场今天朝一个方向波动，明天就可能朝另一个方向波动。他强调需要采取适度保守的方法，这等于坦率承认了俄罗斯正在走的经济钢丝。这番话很有意思，因为从表面上看，俄罗斯迫切需要高油价带来的每一分钱。国际金融协会的研究估计，俄罗斯需要大约每桶77美元的油价才能实现预算平衡。那么为什么还要公开告诫呢？这暗示着一个更深更复杂的策略。一些分析师认为，俄罗斯可能优先将商品价格的波动性作为对抗西方的非对称武器，换句话说，为对手制造价格冲击和能源不安全感，对克里姆林宫而言，可能比最大化自身即时收入更有价值。这让整个全球能源格局变得更加复杂。所以情况很明显了，俄罗斯在一方面发动战争的同时，正在其国内经济上打另一场日益绝望的战争。在这场战争中，克里姆林宫现在公开向其最富有的公民求助，并告诫整个国家前路动荡。展望未来，有几个动向值得留意。首先，预计俄罗斯央行将维持高利率，以对抗战争引发的通胀，这将继续拖累国内经济，并影响俄罗斯的股票和债券。其次，由于能源收入下降和持续的资本外流，卢布可能将继续面临下行压力。最后，要留意更多这类一次性的暴利税和自愿捐款。克里姆林宫越是依赖这些临时措施，就越清楚地表明其正式的财政能力已接近枯竭。本信息仅供参考，不构成财务建议，所有财务数据均基于广播时的市场报告，并可能发生变化。
That's it for today on Voce Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.